Hello and welcome to our discussion of the topic of job order costing. So with this video we will talk about one of the methods for accounting for the product and service costs. As an overview, it is very important that a company understands what it costs them to produce a product or provide a service, and that information, that understanding is important for many reasons. First of all, they can use that to better control their costs and to better budget in general. So without a true understanding of what each individual type of product or service costs, they don't really know when they compare it to actual results whether changes need to be made to the actual activities or whether changes need to be made to the budget. Furthermore, in many situations, understanding the service or product cost is important to be able to properly price that product or service. If you don't know what it costs you, it's hard to determine a price. In multi-product firms, where you don't just have all of one product, you have product A and product B and product C, or service A and service B, to be able to determine which of those products is the most profitable, which one to focus on, you need to understand, again, what each costs and be able to compare it to the price you're able to sell it for and therefore the profitability. Now, it's important when we're talking about cost here, we're talking about all costs related to that manufacturing. So we have direct materials, direct labor, and then we have both fixed and variable overhead, which can include some indirect materials like supplies, some indirect labor, but it could also include things like rent, depreciation, utilities, things like that. But we need to understand all of those costs and how they relate to one particular product or service. Now, again, I said at the beginning that this is one of the costing systems we're going to talk about here, but different companies may use different systems. Job order costing is the main focus of this particular video, but some companies may choose to use process costing as well. Now, even though it technically is a choice, generally the choice is driven by the industry they're in, by the types of services or products they produce. For example, for job order costing, which again is the focus of this video, we're generally talking about relatively larger dollar items, not necessarily high volume, and they tend to be lower volume. They're not mass produced, for example. They're not as mass produced. And generally you're going to have several different products that you're talking about. It's not all a bunch of the exact same product. They tend to be customized or unique, which means that job A will be different than job B, or product A will be different than product B, cost-wise. So we tend to be talking about things like construction, custom order jobs, but we also can bring in services like healthcare or hospitals. For example, I work in the hospital finance area where we audit hospitals for the Medicare program, and we see the Medicare cost report, and it's essentially a type of job order costing system that they use. In fact, later on we'll see activity-based costing in another video, and that's more closely related to what hospitals use to determine their cost. But again, job order costing is the focus of this video. Process costing, just to give a little bit of description of it, we have that in later videos that we'll talk about. But generally, with process costing, we're talking larger volumes, generally lower cost per unit, and they tend to be not customized, not unique. They're very standardized, and they're performed in batches, generally through departments. So the point here is there's no expectation that the cost for product A be different than the cost for product B. And what I mean by that is each unit that comes through, there's no reason to believe one unit is going to cost more than the other. So we're talking standardized, things like paper mills, standardized construction jobs, chemical oil producers where each barrel of oil or gallon of some sort of chemical, it's expected to be the same cost. It goes through the same process. So again, we're focusing on job order costing for this video. We'll talk about process costing in another video. But we need to remember we're talking about the product costs specifically. Yes, there are going to be other overhead costs like the selling, general, administrative, but our focus is product or manufacturing costs. direct materials that go right into the product, direct labor, people that work on the product, and fixed and variable overhead, as we talked about a bit ago. But the key thing here is this is manufacturing overhead. So with the direct costs, we know how much of that each product takes, each unit. It's pretty easy to identify the materials and the labor that goes into each unit. So they're assigned or traced. Those are two terms commonly used. The idea here is that it's a precise amount. We know how much. We can easily measure it and prove it. It's not an estimate. It's not an allocation per se. Whereas indirect costs, which is our manufacturing overhead, we don't exactly know, or we don't want to take the time to track it because it's so small amounts. So we instead have to estimate it through allocation to each job. Now again, this is the best estimate possible. We're not trying to be as precise as we were with direct costs. We're trying to estimate it as best we can. It's not intended to be exact. It's good enough for our decision making. So we have something called the job cost sheet, which each job or product or service is going to track all the costs that it's used up. So think of a construction job or multiple construction jobs. Each job is going to have the record of the materials and the time and the overhead that it's used up. So the documentation of costs for materials, we have something called the materials requisition form, which just means that the job, the foreman, the construction manager, whoever, requested materials to be put into this job. Yes, the materials were in the supply room before, now they're going to this job. There's a time card so people can track where they have spent their time, what job they've worked on. This is a brief illustration of how this would work. You have direct materials, direct labor, manufacturing overhead. So I said the materials go to a job through the materials requisition form. Now on this sheet, we just have the illustration of one job, job A. But in reality, there's going to be job B, C, D, E, somewhere else, and they're all going to have a document that ties to them as well. For simplicity, I'm just showing one job. Out of all the direct materials we have, how many were used for job A? Out of all the labor we've used throughout the period, how much was used for job A through a time card, time ticket, whatever term you want to use? Now, manufacturing overhead is a little bit different because we've already, by this time, we should have determined a predetermined manufacturing overhead rate, which means that it's a amount per hour, per labor hour, per machine hour, per unit, some sort of rate that estimates how much overhead gets used up by each job. All of those job costs go into this final document, so in the end, we know how much cost goes to job A and then job B. We can compare it to our price to determine if it was profitable or not. Now, we talked about how direct costs like materials and labor were pretty straightforward, and that's generally what you'll see in managerial and manufacturing accounting. The complexity of that job order is usually just due to overhead allocation. So we have all those overhead costs like indirect materials or supplies, indirect labor like supervisors, managers, janitors, security, in the factory. That's the key thing here. We have rent, depreciation, utilities, just a variety of things that relate to the manufacturing, but we couldn't really tie directly to that product. So that's what I mentioned earlier. We're only talking about the factory overhead or the manufacturing overhead. We're not talking about selling, general, and administrative costs. That's a different type of overhead altogether. Now, what generally happens, as we said in the earlier slide, is that they use at least one predetermined overhead rate. Sometimes they'll use multiple. So you might have an entire plant-wide predetermined overhead rate, or you might have one for a few different departments if we believe the overhead is consumed and used up in different ways for different departments. Some of them might be driven by direct labor hours. Some might be driven by machine hours. We'll see some options in just a bit. And then in some cases, you have several rates used. Now, this is discussed more when we get to the activity-based costing, which is another video altogether. You'll see a lot more of that discussion. So before we can go much further, we have to identify just how do we allocate this overhead. And specifically, how do we calculate the predetermined overhead rate so that we can apply it later on. Step one for this is that we have to estimate the total manufacturing costs. Now, I have estimate italicized because we, at this point on day one or before day one of the year, we don't know for sure what our total manufacturing costs are going to be. We're just estimating them because we need to have some estimate to work with throughout the year, even before we know what the final total overhead costs are going to be. So we estimate, well, first of all, we identify what those overhead items are. What do we usually call overhead? Indirect materials, labor, depreciation, rent, all that. We add up our estimates, our budgeted amounts for those, and in this case, we're getting $100,000. Step two, as a company, we identify what cost driver or allocation base do we think we need to use to allocate the overhead. Now, let's simplify it and say we're just talking about one to start with. But again, the term cost driver means that something, some type of activity or some type of just this thing is driving that overhead cost. Something's causing us to have more overhead. Now, in many, many cases, in the simplest cases, companies just decide to use direct labor hours to allocate overhead. And, decades ago, this would have been pretty fine because most of the cost was labor, and yeah, you had a little bit of overhead. The labor is already tracked. You already have a good tracking system for labor hours because you need it for labor cost. So they just piggyback off of that, and they say, hey, let's use the same thing to allocate overhead. In other words, if a job A had twice as much labor as job B, well, hey, it's also going to get twice as much manufacturing overhead. So we're going to use this one for the example, but what I want to stress here is that over the years, operations have changed, and much of the overhead is caused by machine time, just the use of machines in production. It's automated. Some departments may be more heavily automated than others, but the point is more of the cost has shifted away from direct labor and into machine time. So using direct labor hours to allocate overhead that's mainly caused by machines may not always be the best result. Instead, you may choose using machine hours. Yes, it's one more thing you have to track. You have to now have a metric, a measurement system for the machine hours, but it certainly in those cases makes for a better estimate. Now, in even simpler cases, you might just simply use actual number of units being produced. The problem with this, of course, is that it assumes every unit uses overhead in the exact same way, which probably is not the case. Now, we talked about direct labor hours. You could decide to use direct labor dollars instead. So what that basically means is instead of a dollar amount per hour for direct labor hours, you'd generally be using a percentage of direct labor dollars. So your overhead result might be 110% of direct labor dollars or 150% of direct labor dollars. Same with material costs. But the point is, in a perfect world, you'd be able to find something that you can easily measure that very closely approximates how you use that overhead. Again, for simplicity, we're just going to use direct labor hours. So step three is that we have to estimate, again, keyword estimate, the total quantity of, in this case, the direct labor hours that we plan to use. It's an estimate. It's done up front. We don't really know for sure how many hours we're going to use. But let's say we believe we're going to use 10,000 direct labor hours that year. So that's our estimate. Step four, we can take all of that data and calculate a predetermined overhead rate. We take the estimated total cost that from step one divided by the estimated total allocation base, in this case the direct labor hours. So 100,000 divided by 10,000 gives us a $10 overhead cost per hour. Now the key thing here is that has nothing whatsoever to do with the actual labor cost. You might be paying them $15 an hour, $20, $30 for their actual labor cost, but this $10 per hour is an overhead add-on. It's not being paid to the employee, it's just being charged to handle overhead from the company perspective. Now step 5, so keep in mind, step 4, we now have a rate, $10 per hour. Every hour of direct labor that's used by any of these jobs, that's going to accumulate $10 of overhead cost for that job. So now we start getting to actual data. Up to this point, it's all been estimates at the beginning of the year or even before the beginning of the year. Now that we're into the year, we're working on the jobs. As an hour is used for job A or product A, in this case we used 150 hours, we're going to multiply that by the $10 predetermined overhead rate, and we're going to find out that we have $1,500 of overhead that needs to be applied to that job. So that's the key thing here. It's now being moved over to that job. If another product used 10 direct labor hours, it would get $100 of overhead cost applied. Keep in mind now these are actual hours. You know, we estimated that we were going to use 1,000 or 10,000 direct labor hours. Maybe throughout the year we start using way more than expected. That's fine. We'll see what happens later on, but we continue to apply it based on the estimate, the estimated $10 rate. Actual hours times the $10 rate gives us our applied overhead. Now step 6. Now we're at the end of the period. We compare the applied overhead when we add up all the different jobs, compare that to our actual overhead. So let's say at the end of the year, we end up with only $85,000 in overhead. We thought we were going to have $100,000. We really only had $85,000. And I'm not talking applied. This is the actual bills that we've been paying for overhead. And in this case, let's say we had 10,000 hours actually used. Therefore, we would have applied $100,000 as we expected. 10,000, our budget was right on. 10,000 times, and our budgeted hours were right on, I should say. 10,000 times $10 means we would have applied $100,000 to each of the job or to all the jobs together. But the problem is we only really had $85,000 in overhead. So we applied too much overhead. We over-applied overhead. Because of this means that either our inventory accounts or the cost of goods sold account, which we'll see in a bit, has too much cost in it. Our estimate was wrong. We put too much cost there through application. That's example 1. But now let's take example 2. Let's say, hey, we add up all of our bills at the end of the year. You know what? We really did have $100,000 in overhead. Our total cost estimate was right on track. But let's say that our labor hour estimate was not. We actually ended up using 12,000 direct labor hours throughout the year, and every single one of them got $10 per hour overhead applied, so we would have applied $120,000 in overhead, which of course is $20,000 too much. The same issue happens here. We've applied too much overhead. We're going to have the exact same adjustment that we'll see in just a bit. Now, you could take both of these situations and completely reverse them. You could have too much overhead, too much actual overhead, more than what we applied, and that would mean that we under-applied overhead. You could have that situation as well. So you can have a variety of combinations here, but the point is how much overhead was truly applied compared with what the actual overhead was, and we have to adjust it. Now here, to wrap up our discussion of job order costing, we have what looks to be a relatively complex illustration here of the T account. We'll spend a little bit of time on this. And in a later video, we'll see the journal entries themselves in journal entry format. But let's look at all of the different things and how they flow. We have raw materials, which is an asset. It is an inventory account. And to track our direct labor cost, we're going to use salaries payable. Yes, the other side of that would be salaries expense generally, but we're going to look at salaries payable first, and I'll explain why in just a bit. So, and the payable is a liability account. So it has a normal credit balance. The asset has a normal debit balance. So when we first buy new materials, we're not using them yet, we're just buying them. We have to debit our raw materials asset to increase it. So we have materials now. Now on day 2, we start using some materials to build products. So in that case, there's the materials requisition form for job A or job B, whatever. We would credit raw materials inventory because we're using them up, we're decreasing that, and we would debit work in process inventory, which is also an asset account. It's an inventory account. Work in process means it's not yet been finished, but we've started to add costs to it. So we debit work in process to increase it, credit raw materials inventory to decrease that. Now we have some costs in there. Let's also take a look at the raw materials inventory. Some of those materials were just supplies or indirect materials that aren't going directly to one job. So we credit those because they're still gone from the inventory asset, but the debit has to go to the manufacturing overhead account to add to that. Now, as far as what that account really is, there are kind of a couple ways of thinking about it. The most common way, the way I like to think about it, is that it's a collection of expenses, a temporary holding place for these expenses. So that's why it has a debit balance to increase it. It's like an expense account. If it makes it easier for you to think about it as kind of a quasi or temporary inventory account, I suppose you could. It's not the most proper way of thinking about it, but they would still have a debit balance to increase it. So in any case, we're debiting manufacturing overhead to add to those costs. These are actual costs, and we're crediting the materials. Now, we basically end up doing the same thing with labor. We don't have a debit to salaries payable because we're not ever, we don't have a storage place for salaries. We don't debit this to keep it as an asset. This is a liability. So when we have labor used, we credit salaries payable because we owe our employees. The debit, instead of going to salaries expense, it goes to this work in process inventory account to add more costs in, to increase this inventory. Now, just like materials, we might have indirect costs, salaries of supervisors, managers, security. So we'll do the same thing there. Credit salaries payable. That becomes another cost that goes into manufacturing overhead as a debit. So the point here is we keep adding into manufacturing overhead with a debit to keep track of all these expenses. These are actual costs as they come through. Now, the other thing with work in process inventory, the last cost we'll have is applying overhead. So remember, we set our rate based on labor hours or whatever. So as labor hours are used, we're going to apply overhead to production. So to apply overhead, you credit the overhead account to reduce it. So the thing to keep in mind there is your manufacturing overhead on the debit side, that's when the actual costs come through. The estimated application of those costs is the credit. We're reducing that overhead account. Now again, I have an arrow going over here to remind you of the calculation for applied overhead. You take whatever your predetermined overhead rate was, multiplied by the actual quantity of that cost driver, like direct labor hours. We apply overhead. The next thing that happens is you finally have finished one or more of your jobs, so we need to move it out of work in process inventory and over to finished goods inventory. So to move it out of work in process inventory, an asset, we credit it to reduce it. The debit for that account goes to finished goods inventory, also an inventory asset. So we now debit finished goods inventory, and it just sits there until we finally sell it, in which time we credit that finished goods inventory to remove it, and we debit an expense account the cost of goods sold. So the final thing we have to worry about here is we're at the end of the period. We've completed some of the jobs, but some of them are still in process. We have to take a look at our overhead account to see if there were any errors in our estimate. Like I said earlier, we sometimes are we have under-applied overhead, which means we have not applied enough. There's overhead left here that we have not applied to production, or in some cases we applied too much. So think about your normal balance rules and think about this being, just say, an expense, a collection of expenses. When we compare our debits and credits, if we end up with extra on the debit side, we haven't completely zeroed it out, this means that we have some overhead that we haven't applied. There's overhead left, actual overhead that we have not yet applied. So it's an under-applied overhead. It ends up with a debit. To close that out, we first of all have to credit manufacturing overhead for that amount to zero it out. And the debit to that journal entry, for simplicity, it usually goes to cost of goods sold, which means it's adding that additional amount of cost in. That cost of goods sold is an expense as well. So that zeroes out manufacturing overhead, and it finally adds in that little bit of remaining cost in the cost of goods sold. I'll get to more on that in just a bit, but let's say it's the other way. Let's say we have a credit balance in the end. That means we applied more overhead than we actually had. So that means there's too much cost in the cost of goods sold. Since we end up with a credit on the manufacturing overhead, that means we have to debit it to close it out for that amount. And then the credit to that journal entry goes to cost of goods sold to pull back some of that overhead that really didn't exist. Now here's the other point I wanted to mention. For simplicity, I said this usually goes to cost of goods sold. That would work perfectly if the company very quickly finishes its product and sells it. In other words, if it doesn't really keep too many inventory balances around, then this is absolutely the adjustment you need to make. But if this company has a lot of inventory stuck in finished goods or work in process, then the problem with that treatment is that some of these errors actually should impact work in process, finished goods, and cost of goods sold. In those situations, sometimes they'll tell you that we're going to prorate it between the accounts. So for simplicity, let's say the balance of work in process is a third of the total of these three. In other words, they're all a third of the total. They're all equally spread out. In that situation, you'd just say, let's take this error, this over or under applied overhead, and spread it equally three ways. But it could be, 25, 25, 50, or whatever, 10, 10, 80, whatever your percentage is, that's the proration you're going to use to correct this overhead error. That's the point. But again, in most textbooks, and for that matter, in most companies, they'll say, let's just adjust cost of goods sold and be done with it. So that takes us to the end of the discussion on job order costing. But what I wanted to mention here is there are some related videos out there that we've posted for journal entry examples for job order costing. There's an important topic called the cost of goods manufactured statement or report and the income statement. These are usually at the end of the job order costing discussion. This wraps up the period, so you'll definitely want to see that video. And there are multiple practice exercises for each of the different elements of this topic. So please feel free to see those videos if you still have questions on that. And as always, I just wanted to point out I do have a variety of other accounting videos available. You can see my YouTube account here. You can search for that, or you can search for Severson Accounting YouTube. Here is a list of my videos in a spreadsheet format that I have out on Dropbox.com. Now, obviously, this link is much longer than you'd ever want to type in, so I do have this link in the video. And if all else fails, if you're unable to get to that link, feel free to comment on this, and I can respond with that link in that format. So thanks for your time, and have a great day.